And welcome back. Today we're going to have a lot of fun. We're going to do a reacts video. As I'm sure you can imagine, it's not that infrequent of an occurrence where one of our clients, usually a younger client, will go off and watch something on YouTube or TikTok that has to do with financial planning or tax strategy, and they'll come and ask us about it and go, like, why aren't we talking about this? Why aren't we doing this? We're missing out. And we kind of have to talk them back down and go, well, hey, here's why that doesn't apply to you. So we found this video we're going to use. It comes from the YouTube channel School of Hard Knocks. And it is an interview with a tax professional, Mr. Carlton Dennis, who practices out in California. And so I'm really excited for this. I think it's gonna be fun. Let's jump right in. And for the interest of time, we'll kind of be skipping through the video a little bit, but we'll go ahead and get it started here.
We got to go get this game from him. Come on, you guys. Man. Carlton, what's going on, man? How you doing?
Good to see you.
Great to see you.
Yeah.
Thank you for having us out here,
Welcome
man.
to Orange County, man.
Seriously, man.
Yeah.
The last time I saw you, man, our video did 60 million views together.
60 million?
60
Are
mil.
you serious?
48 million on Instagram, another 50 million on TikTok, and however million on Facebook, man.
Changing lives.
Yes, sir.
Let's
super,
go.
super happy to be out here, man.
I'm glad
So,
to have you out here.
we talked about it in the preview.
Yeah.
People saw the interview.
Yes.
You made how much money this last year?
All right. I made 7.1 last year in 2023. 2024, we just crossed 11.5 million.
And how much money did you pay in taxes for those that don't know?
Last year, I paid $0 in federal taxes, $26,000 in state taxes. And this year in 2024, I'm on pace to pay less than $92,000 in total taxes.
Now, how the hell was this possible, man? Because that's insane. You're touching 8 figures, high 7 figures in a single year,
Yeah.
and you're not paying anything in taxes. That's ridiculous.
Yeah. How am I doing this? Okay. So
Yeah, but first of all, is that legal?
everything I'm doing is legal. Everything I'm doing
So
is legal.
if the IRS wanted to come after you,
I welcome them. IRS, you know who Carlton Dennis is. I have one of the largest YouTube channels for tax strategy. The IRS knows who I am. I'm not afraid of the IRS. I'm not afraid to use the tax code against the IRS. And everything that I do is by the book, which is why I have so much fun with the tax code. I focus on income shifting strategies.
Okay,
How do I
we'll,
take
go ahead and, we'll pause it there. Okay, so I think I just want to start with a confession. I love watching these kinds of videos. I love it so much. It's like my guilty pleasure of pulling these videos up and watching. And obviously, like, I'm involved in this world of financial planning and tax planning. It's just so much fun. And I think 60 million views, they said, right? I think the reason why it's so interesting to a lot of people is we love this idea of this extraordinary individual with a unique skill set who finds a way to pull one over on the IRS, right? And just kind of beat the big guy, right? And so in this case, I mean, this guy's obviously, he's handsome, intelligent. He clearly knows his stuff, as we'll see. I mean, he's a legitimate tax professional. Like, nothing I'm going to say today is going to try and dispute what he's saying or that it's not factual. I think really what I want to come at this with is kind of the perspective of applicability, right? I kind of want to translate some of what they're going to be talking about and to help you decide, does this apply to me as kind of the typical viewer of something like this on YouTube? Okay, so with that perspective, we'll kind of jump into, I think he's actually about to say kind of one of the first things I want to comment on.
is by the book, which is why I have so much fun with the tax code. I focus on income shifting strategies. How do I take money off of my tax returns? I focus on depreciation. How do I create a paper loss by investing in real estate? And most importantly, I'm philanthropic. I have a private family foundation that gives money back to other charities outside of my own that allows for me to also reduce my tax bill. These are the 3 things that I do every single year that keep me at 0% on the federal side. And I do pay a little bit of that Cali tax, but I'm okay with it.
yes.
Okay, so he mentions 3 strategies at the bat. He says income shifting, he says depreciation, and he says philanthropic or charitable kind of activities. So if you hear those things, you go, I don't know what any of those things are, you can pretty quickly Google or ChatGPT or other AI tool and figure out what those are. I want to point something out. So on that 3rd one, philanthropy or charitable giving, here's what typically happens, right? You can only get so far in offsetting, taxable income with those first 2 strategies he mentioned, right? So income shifting and depreciation. And so let's say at the end of the day, you get down to it and you still owe some taxes. And so a lot of wealthy individuals will then turn to charity and they'll give to charity as a way to kind of offset some of that taxable income. I want to point something out. A lot of people don't realize about a charity, or you would realize it if you just kind of sat and thought about it, but it's not top of mind. You see that and you go, yes, I should be doing that. If you're trying to give money away to get a tax break, usually you actually have to give more away than you would actually owe in taxes. Meaning whatever your tax bill is, you go I want to save that much money in tax. you would have to give more away. Okay, so quick example. Let's say you're in the 22% tax bracket and then you want to save $10,000 in tax, right? So $10,000 is what you want to save. Well, for each dollar, that dollar that you're saving is actually only 22% of the gift, right? So you have to take $10,000, the desired, tax break, and divide it by 22%. So you're having to give away like $45,000 just to save $10,000 in tax, right? Assuming you're in the 22% bracket. So it's different for each tax bracket. But point is like, it's not like you give $1 away and you save $1 in tax. Here's some of the underlying assumptions of what he's saying that you can judge if it applies to you. Number one, he's seeming to assume that money's not an issue. I guess that cash and cash flow is no object, right? I'm not really worried about money. I just want to pay taxes, right? That's kind of an assumption. And I think for most people, I figure most of those 60 million people that watch their other video, that's probably not the case. Money is the issue, right? I don't have enough money. I don't have enough cash flow, right? So, that you got to kind of point out that assumption. And then the other one, let's say you're watching that and you go, well, yeah, money is not an issue. I have plenty of money. I have plenty of cash. Well, the other assumption is are you charitably inclined, right? So some people may have enough money to do like that, but they don't want to give the money away to a charity, right? So those are two key assumptions there that you maybe want to pump the brakes on what he just said because it sounds great, but you gotta kind of think through that to go, does that apply to me? All right, so let's pick it back up.
Picking the Lamborghini up.
Yeah. Now, what's crazy is most people look at cars like this as the depreciating assets. How do you feel about that perspective that people give you whenever they say that about cars?
Cars are depreciating assets. I 100% agree with them, but I also took 100% bonus depreciation on this car, which saved me, I don't know, about $92,000 in taxes. That $92,000 got reinvested into a multifamily property in Texas. That's paying me cash flow of about $1,400 a month. So if you're somebody that knows how to do math, you can buy a vehicle like this, offset your taxes, reinvest the tax savings into a cash flow producing asset, and not worry about the fact that this car is still losing value sitting here in the driveway because it losing value offsetted my taxes.
Right. So the G-Wagon right here, why is it eligible for that deduction? Is it because of the size and the weight of it? Or
Yeah. So with this G-Wagon, the gross vehicle weight ratio is over 6,000 pounds. And if you have a vehicle where the gross vehicle weight ratio is over 6,000 pounds, plus the vehicle is being used more than 50% for business, the IRS will allow for you to take the vehicle's purchase price and write it off on your tax returns under Code Section 179 plus Code Section 168K. So I utilized this strategy in 2022 on this vehicle right before bonus depreciation went to 80% in 2023. We're here in 2024. Bonus depreciation is at 60%. Donald Trump just got elected president. He's expected to get inaugurated here in the next couple of weeks. There's a possibility that bonus depreciation could go back to 100%. And as a tax professional, I'm waiting to hear about that.
wow.
Okay. Man, he's good, isn't he? He's just fun to listen to. He's super articulate. And again, he knows his stuff, right? So nothing that he said just there like jumps out to me as being inaccurate at all, right? Again, the question here for us is it applicable to most people, right? So let's kind of dive in on that. So he's talking about depreciation there, okay? So let's start with definitions. We hear this word, we know about depreciation, but like what really is it? Depreciation is a type of business expense. We'll just kind of keep it there, right? I'm sure, online it says some other like formal definition, but just think about it in terms of a business expense, right? So the point is like if I buy an asset like a vehicle for use in a business, right? I, as a business owner, I'm kind of placing a bet that I think that asset is going to help me earn income for the business. Now, over time, what the IRS is saying is that, over time, assets like vehicles or, properties or anything else, they kind of deteriorate over time, right? And so what they're allowing you to do is in each kind of like tax return period, they're allowing you to get credit for that deterioration of the asset. Okay. And that's called depreciation. And so for each period that the kind of the value or the use of that asset is declining, you're able to claim the appropriate amount and use that amount to offset the taxable, profit of the business. Couple things, business. How many times I've said business? So this is applicable in the context of a business, not a personal use. Okay, so the IRS allows you to claim depreciation to offset taxable income if that asset is used for the generation of income. Okay, and from their perspective, the IRS, that is, they want to incentivize you to make investments, prudent investments that will generate income that, guess what, they can tax you on. Okay. So this is all in the context of business. So if you're watching this and you go, I don't have a business and I don't have any kind of like feasible, like reasonable field of business that I could get into to generate income, this isn't going to apply to you. Okay. The other thing is he mentioned the bonus depreciation. This is kind of like an exception to how depreciation is typically done over time, as I mentioned. And again, this is kind of like a recent tax law that allowed for this, where you can take all of that future depreciation, you can bundle it all up in that first year and take it all as one big deduction against taxable income. That's great. Again, it's legit, right? You can offset a big tax year by doing that. But then what? So what happens? So for example, let's play that out. If he takes the bonus depreciation, then eventually, let's say he sells the vehicle. What typically happens when you sell an asset like that, what you would do is you would pay tax on any gain over and above what you paid for it. Okay, so like, let's say you bought it for $150,000 and you sold it for $175,000, you owe tax on the $25,000 gain. This concept that I said, what you paid for it, there's a technical tax term for that. It's your cost basis. When you depreciate an asset, you will lower your cost of basis. You're using it up, right? So when you do bonus depreciation, in one fell swoop, you brought your cost basis or what you paid for it to zero. So if you turn around and sell it for $175,000, now instead of paying tax on the $25,000 gain, you're paying tax on that full amount. And so that component that you depreciate is recaptured. So he didn't mention that, you know what I mean? So A, does it apply to you if you don't have a business? No. And B, the bonus component of the depreciation, while good in the short term, it does create ripple effects in the future that you need to be aware of. Just a little bit of nuance that they're not quite getting into on there.
Through right now?
Could we?
Let's break it down on the whiteboard.
Let's go.
Let's do it right now.
Awesome.
Let's do it. All right. So we said 100K, right?
Yes.
And this could be 100K W-2, 1099,
Entrepreneur.
Okay, it's 100K. Now let's just say that I want to use a rental property to offset my taxes. I'm gonna have to come up with a down payment. But here's what I could do. Let's just say that this property is $500,000 and I had a separate $100,000 that I saved up. So I'm gonna take out a $400,000 loan. I could buy this $100,000 property. I just need one property. And what I'm going to do is I'm going to list this property as a short-term rental. Here's the reason why. If I list this property as a short-term rental, and if this property has tenants that stay in the property 7 days or less, and I manage the property for 100 hours, I can perform a strategy on this property called the cost segregation study. Now, this property right here is worth 500K, but with a cost segregation study, I can accelerate depreciation. On average, when performing a cost segregation study, you can get 20% of the building's purchase price as a year one tax write-off. So with $500,000 property, 20% of that would equal $100,000. If I had $100,000 W-2 income, and I had a $100,000 loss on my tax returns from depreciation, I'm tax-free. And this is how somebody can take a $500,000 property, convert it to a short-term rental, manage it, create a paper loss, and offset 100% of their W-2 or 1099 income. And this is just with an example of someone making 100K. Imagine if there's somebody that's making $1 million,
Okay,
and we took this property to $1 million.
Okay, man, that's fun, right? Because you see that and you're like, I got to do that. Why am I not doing that? You know? Okay, so did you catch it? There was a thing in there. I don't know if you caught it. Maybe we can roll it back. I think it's at 1441. Let's replay it and see if we can catch that.
And I had a separate $100,000 that I saved up.
That was it. That was it.
I could buy this.
Did you catch it? Okay. So in this scenario, so this person makes $100,000 a year and they want to offset that. And he kind of just goes, and let's say I had a separate 100,000 just sitting on the side. Well, where'd you get that separate 100,000? Okay, let's kind of go down that rabbit hole a little bit. Okay, so this person makes $100,000 a year. How much of that goes toward their rent, right? So let's just kind of break this out and see really how did they get to that extra 100K that was just hanging out over there, right? So $100,000, I typically, let's just kind of say 30% of that is going to be a housing cost. It's depending on what kind of part of the country you live in, that's pretty fair, right? So then now you're at $70,000. Well, you got to eat, all right? And so let's say, I don't know, a single individual, maybe a little over $1,000 a month. We'll just say like $15,000 per year by the time you go out and stuff like that. And then you got bills, right? I mean, you've got gas, electricity, you've got your cell phone, all the streaming services. I don't know. Let's take off like another, call it $10,000. We're down to $45,000. Okay. Also, we haven't paid taxes yet. right? Because this is a tax strategy for this year to offset this year's 100K. And we had to have $100,000 to do it. So presumably we haven't done it in previous years unless we have a money tree. So we had to pay taxes, $100,000 in taxable income. I don't know, you might owe, I'm gonna say like $12,000 on that. All right, so down to $33,000. I hope you're saving for retirement. I hope you're contributing at least 10% of your income to your, call it 401k, $10,000. So down to $23,000. Let's see, what else are we missing? Can you think of anything? Oh, good point. Yeah, you got a car payment, right? So thanks for the assist, Jill. Let's say, I would just say another $10,000. Anyway, and we're being pretty conservative on some of these things, but it leaves you $13,000. And then there's also like, are you going on any trips? Like, are you giving any Christmas gifts? So you can pretty quickly get through that remaining $13,000. But let's say you're left with like $10,000, right? That you could, after you save for retirement and do everything else, like potentially save. So it took me 10 years to save up that $100,000 that he just casually goes, and let's say you got $100,000 over here, right? You know, this is totally legit and it could make sense and it could work, but you don't just do it. It's like this premeditated thing, right? For your average person out there who's a W-2 employee, it's got $100,000 a year. If you were to want to do this, you'd have had to been planning for a long time to do this. You know, the other thing I didn't factor in, like if you're earning $100,000 a year, and we're presumably talking about a 10-year time horizon to get to this point, you weren't earning $100,000 this whole time. Maybe you started that period at like 60 and worked your way up, in which case it would take even longer. So on the whiteboard, he's trying to make the math, work evenly. I get that. It's just kind of an illustration, but it's not that easy. It's one of those deals, like if it sounds too good to be true, one thing that could have happened, right, is maybe that person had like an inheritance, some other kind of a windfall or something like that. And that could be the case. But again, for most people watching this, you look at it and you go, is that really applicable? Okay, let's just kind of give a little grace here and go like, okay, let's say it's an inheritance and that's how they got it. Well, is it going to work? Is it going to work, right? So you got this short-term rental. You have to kind of meet all those requirements that he mentioned to be able to do this tax strategy. Can we get the cash flows to work? Do you have any experience running a short-term rental operation? Because you just took out a loan for $400,000. Let's dive into that, shall we? So you took out a $400,000 loan, consulting the old calculator here. Let's say you did a 30-year. So, and let's say just ballpark interest rate on that, let's say a 7%. Right, so the payment just to the lender, just principal and interest, $2,600. So $2,600, and then you got your taxes, and then you got your insurance, and then you got, who's going to manage that? Are you going to go clean the property every time? Or are you going to pay someone, usually about 20% of the rental revenue, to go and do this? So pretty quickly, there's this hurdle here. The operation of the short-term rental has to surpass, or guess what? Next year, you'll be dipping into that $100,000 that you're earning from your day job to subsidize the operation of the business. A guy like me, a financial planner person, might look at that and go, you got $100,000 coming in and you've got $100,000 sitting on the side over here, magically, cough, cough. Why don't we just max your 401k, right? So $23,500 goes into the 401k. If that impacts your cash flow, guess what? You can dip into that 100K to help supplement your cash flow. But all of a sudden, that's $23,500 less that you have to pay tax on. Oh, and by the way, you don't have to go down the risk of taking on a $400,000 note and operating a business and all this, right? Now, you may be temperamentally predisposed for success in such a rental real estate operation. But again, we're talking about applicability for your average person, and your average person is probably not, right? Of course, they're not getting into all those details, but it's just a little bit kind of extra layers of the onion to pull back there. Okay, so what's our takeaway here? Hey, listen, if you are super wealthy and you have multiple business entities and trusts and everything like that, you probably do want to find someone like Mr. Carlton Dennis who can help you shelter all of that from a tax standpoint. But again, our purpose here today was to determine to what extent are these strategies applicable to you and to the typical viewer, right? So if cash flow is a concern, right, and you don't have just piles of money laying around, maybe this stuff wouldn't totally apply to you. And again, if you don't have multiple business entities, maybe some of this won't apply to you. And so here's what I hopefully will have prevented for you. It's that financial FOMO, right? When you watch something like this and you go, I knew it. I knew there's a cheat code, right? We should be doing this, right? Let me just kind of mitigate some of that and go, no, you're not necessarily missing something. What I would advise is find a qualified professional financial planner who can get to know you and what you're trying to accomplish and give you some kind of the more blocking and tackling type financial advice, as opposed to kind of the high flying acrobatics that this gentleman does for the ultra wealthy. Anyway, hope you enjoyed the video. Hoping to do more of these reacts type video in the future. And by all means, give us a call if we can be of service to you.